Stock started off the year on the wrong foot with the S&P 500 closing lower by 0.4% here today. However, it wasn't as bad as it seems. Most of the sell-off was as a result of stocks like Apple and Tesla that carry a greater weight within the S&P 500. In fact, we actually had more stocks in the S&P 500 close in the green today than in the red. So a lot of the mid-cap types of companies out there held up just fine in today's action. We'll take a look at all of that to see what it means for our postures in tonight's video. We'll also take a look at the sectors. There was one sector that did quite well last year that did quite poorly here today that we'll spend a bit of time on. I also want to talk about commodities like gold and some of the expectations I have out of it moving forward into the new year. And then last but not least, we're going to do a trade application example where we focus on a bearish trade setup on an industrial gases company. So with that, let's go ahead and get started. Welcome to the Market Outlook video presented by MarketScholars.com. I'm your host, Brandon Van Zee. It's January 3rd, 2023. First of all, if you're new, welcome aboard. Remember to go over to YouTube, click subscribe on our channel. Go down below into the description area. Make sure you're signed up for our email distribution list, so that way you can be notified whenever we post these videos. You'll also be given a heads up at the bottom of those emails as to which stocks are giving you overbought or oversold cluster signals within the S&P 500. In addition to that, we're heavy users of Twitter. If you're not doing so already, I would encourage you to follow me at Brandon Van Zee. We really appreciate those of you that click like and retweet on these Market Outlook related posts. And then last but not least, we do have a presence on Facebook. Feel free to join our group at that web address you see in the logo in front of you. All right, let's go ahead and jump into today's trade activity. And as you can see here, I've got the S&P 500 heat map pulled up. It's been a while since I've been with you, by the way. We usually take the week between Christmas and New Year's off, so I was out on a road trip battling the icy and wintry conditions here, at least in the Utah area. I don't know where you guys are all from, but I understand there's some pretty nasty winter weather all over the place. But nice to kind of be back in the flow of things here at my trading desk once again, and feeling nice and refreshed and ready to tackle the new year that is upon us. So if I haven't gotten a chance to say so yet, Happy New Year to all of you who I might have missed there on Twitter. Let's go ahead and jump in to see what happened in the market in the first trading day of the new year. And before we get started with the heat map, I'll just let you know that the S&P 500 was down 0.42% today, somewhere in that vicinity. And so you might assume that when the market's down about 0.5%, that we would be seeing a lot of red on the heat map. And today was one of those oddball days where we actually had more winners than losers. That may not have been the case earlier in the day. At one point, the S&P 500 was actually down over 1%, but we did recoup a number of those losses that happened kind of in the midday as we rallied into the close. So that kind of helped paint a prettier picture for us in the end. But nonetheless, it is kind of interesting that the market was down fairly significantly today, yet the majority of companies were actually up. So how can that happen, you might ask? As most of you are aware, the S&P 500 is a market cap weighted index, which basically means the bigger companies from a market cap size perspective have greater sway over the end results of the S&P 500's performance. So the largest company on the planet, at least here in the United States, kind of going neck and neck with Saudi Aramco, I guess, these days, but Apple is the biggest tech company here in the United States, and something kind of interesting happened to it today. It was down 3.74%, which first of all is a really big day for Apple, right? Apple, it does not get treated the same way that you oftentimes find, let's say, Amazon or Netflix or Tesla. Those are a little bit more exciting companies, you might say. Apple's a tech stock, to be sure, but it's kind of past its really exciting phase. It's more of a mature tech stock at this point. And so it's somewhat rare to see a company like that down about 4% as it was today. But you'll notice as I hover my mouse over the Apple rectangle here, it lost its $2 trillion status with today's 4% sell-off. So it's now just at a $1.9 trillion market cap. I don't think we'll be crying a river for them. Their shareholders have, of course, done very well over the years. Nonetheless, it's starting to take down even some of the most superior businesses out there. This has been, of course, a pretty difficult stretch for a lot of investors over the last year or so. We had our dividend growth investing class today. We do feel quite fortunate as dividend growth investors that we held in there much better than the markets at large. Some of you saw my tweet on New Year's Eve, I think it was, or whenever the last trading day was of the year, and the Dividend Aristocrat list was down 7%, perhaps 8% if you round it up. But to put that into perspective, the NASDAQ was down 33% last year. So there was tremendous difference between the more exciting tech areas of the market and the underperformance that occurred there versus the somewhat stalwart price action of some of the old school dividend aristocrat companies like Procter & Gamble and Johnson & Johnson and those types of companies. So it's been interesting to say the least. Apple didn't fall last year nearly as badly as a lot of the other mega cap tech stocks, but it surely started off this year on the wrong foot. So that stock all of a sudden looking pretty ugly out there. Another red patch that catches my eye is Tesla. It seems like I feel like a broken record here despite not being with you guys for over a week. Tesla continues to fall. It seems like almost every time I was with you guys in the month of December, we would look at the heat map and we would talk about how much did Tesla fall today. It's really quite extraordinary to watch this square or this rectangle drop in size or contract in size as much as it has over the last year. Remember, Tesla was once $1 trillion company in its own right. Today, it's only $341 billion. So the size of that rectangle has shrank by 2/3 as we've been kind of together here looking at these heat maps on the Market Outlook video over the last year. Tesla today was down another 12%. It ended today at $108. So who knows, maybe some folks will step in at the nice round number of 100, but it has been extraordinarily bad for Elon Musk and any of the Tesla shareholders out there. Fortunately, my classes do not have any exposure there. We did have a bearish trade on it, I think back in November, but we successfully closed that one down at max gain. So I'm watching from the sidelines, kind of, with the popcorn in the hand, kind of watching from the cheap seats, while the rest of you are trading Tesla and duking it out with one another. It's been really interesting to watch, but one of the worst performers, especially from a mega cap perspective over the last year, Tesla. In terms of other big red squares that are out there, you could probably throw United Healthcare into that conversation. It started the year off down 2% today. It is either the biggest or second biggest healthcare company. It always kind of goes neck and neck with J&J. Right now, J&J is $465 billion. United Health is $484 billion. So right now, United Health is just a hair bigger than Johnson & Johnson, and it did suffer a 2% drop here today. NVIDIA also had a bad day. Similar to Tesla, NVIDIA has been in an extraordinarily bad downtrend for the last year. NVIDIA itself was close to $1 trillion market cap, and today it's down there close to Tesla's size at about $352 billion. So the amount of money that has been lost with some of those mega cap tech-oriented types of companies has truly been breathtaking over the last year or so. In fact, I just got done posting on Twitter a graphic from Visual Capital or Visual Capitalist, and kind of showed from a one-year perspective how this heat map looked, and where the vast majority of wealth was lost is in some of those more tech-oriented areas, whereas you did find that a lot of healthcare and insurance and defense types of companies like Raytheon, Lockheed Martin, and them, they did a lot better. So if you're interested in that, feel free to check out the my Twitter feed. I could probably pull it up here real quick. Give me a second. I'll give you a sense of what this looks like in case you're looking for it later on. But it would be this one right here. So it was just posted here a couple of hours ago. You may have to zoom in on this. And by the way, on the tweet itself, I do have a link to the actual website that displayed that graphic originally. And they do a really nice job of showing us where the winners and losers were for the full year of 2022. Of course, stocks like ExxonMobil in the energy patch did quite well last year. Stocks like McKesson and Cardinal Health and AmerisourceBergen did really well in the medical distribution area. Stocks like Progressive and Chubb and Aflac and some of those types of companies did really well in the insurance area. Stocks like Northrop Grumman and Raytheon and Lockheed Martin and General Dynamics did well with the aerospace and defense area, of course, with Russia-Ukraine going on. And then the big drug manufacturers, stocks like Merck and Lilly, did quite well last year. Even AbbVie did quite well. Some of you know that name as a dividend aristocrat. And then underneath this graphic, we'll show kind of where were the losers. And one of the key areas of losses last year was, of course, technology. Stocks like Coinbase were down 86%. Content and entertainment did poorly. Stocks like Meta/Facebook down basically by 2/3. Real estate did poorly last year. Stocks like Digital Realty down 43%. Asset management did poorly. Stocks like Blackstone did returned a negative 42%. Remember, that's not BlackRock, which is a different company. Blackstone is more of the private equity. It's been in the news a lot more recently with the BREIT, which is private real estate ownership that some of their clients have access to, and some of the liquidity problems they've been having here recently. And then auto manufacturers, of course, did very poorly last year. Stocks like Rivian down 82%. Lucid did poorly. Tesla, of course, did poorly. And then you can kind of see the breakdown in the middle there. I know for those of you that might be watching this on your phone right now, this is going to be hard to see, but they do a nice job from a more graphic point of view of kind of identifying the areas of strength and weakness last year. So feel free to check that out in your own time if that is of interest to you as well. The other thing that I should point out here on the heat map for just today is the underperformance of energy. Let me actually zoom in on energy by right-clicking and going to energy only, and you'll see that it appears that every single one of these cells was in the red here. Not a single winning stock in the energy patch here in the S&P 500 specifically. Stocks like Exxon down over 3%, Chevron down over 3%, Conoco down over 4%. So some pretty big haircuts there. And that's somewhat noteworthy considering what happened last year. Some of you may recall that energy was like a light switch last year. As soon as we turned to calendar year 2022, energy almost immediately started outperforming and then started to pour on even further outperformance once Russia-Ukraine really kicked off in kind of February, March time period. So it's interesting that this year it's exactly the opposite so far. Obviously, we're only one day into this, but it is kind of stark, the contrast between the 2 years, where all of a sudden energy was probably today's worst performing sector. And from a consistency perspective, all of these were lower here today. Remember how the business cycle and economic cycles tend to work. A lot of times oil and materials do well going into kind of the last hurrah of a bull market, but then oftentimes it's those high prices of those commodities that helps accelerate the decline in the economy, right? Once oil prices and other materials prices get too high, then the companies that need to use those to build products and services and things like that, their profit margins get squeezed, and therefore the stocks of those companies roll over. And if the stocks of those companies are rolling over because they're not selling as much product, then they don't need to buy as much inputs from the oil companies, which causes their prices to go lower. So kind of basic economics 101 there. But there's kind of a lagging effect is the point of what you tend to find with the commodities. So I'd say there's a pretty decent chance that we do see some significant give back in some of those commodity areas here this year if we kind of follow the normal course of action. Let's go back to the full view here. And let's talk about some of the big winners here today. Amazon had a good day. It was up 2%. It's not quite a $1 trillion market cap anymore, $875 billion, but it's knocking on the door. Meta had a good day, but again, after losing 2/3 of its value last year, that's it's not really saying much when it had a good day when it was up 3% here today as it was. Alphabet was up over 1%. Of course, some interesting news with Alphabet getting the rights to the NFL Sunday ticket next year. And of course, hearts and prayers and thoughts go out to those of you that are Buffalo Bills fans. That was quite the traumatic situation that happened in the Monday Night Football game last night where one of the Bills players had a heart attack basically right on the field and had to cancel the whole game. So not the way you want to see those games play out. But nonetheless, the NFL remains a stalwart in terms of the amount of eyeballs that it attracts. And with Alphabet having access to the Sunday ticket starting here in the next couple of years, it could very well become a major player in that area as well. So keep your eye on that story. I mentioned Johnson & Johnson before. They were up about 1% in the healthcare space here today. Berkshire Hathaway, from a mega cap perspective, was up a little bit. JP Morgan was up a little bit. Bank of America up a little bit. Walmart up a little bit. There were some areas that definitely caught my eye just from a personal interest perspective that were up nicely today. You can see that one of today's best stocks, in fact, the best stock in the market today, was Newmont Mining, or Newmont Corporation. Some of you may recall that before we had our Christmas break, one of my bullish trade ideas was on Newmont Mining, and I remember one of the commenters from the peanut gallery said, "You're too early on Newmont." And I said, well, I could be. I never know for sure. I take the trades of what my eyes see, and I know you guys will have your own opinions on what you believe with those situations, but so far so good on Newmont. It was the best performing stock in the entire market here today. Also, I noticed that Target did pretty well today, up about 2%. That was another recent bullish trade that I did. In fact, one of the oddball things that happened today, some of you probably might not have noticed this because all of your portfolios are made up a little bit differently, but if we look at the portfolio that I have here for the Market Outlook account, remember David and I have accounts for all the different classes that we teach, so this is the one that I use specifically for the Market Outlook. An odd thing happened today. Every single one of our positions was either flat or up today. I didn't have a single losing trade out of all these trades that we've done. If you look at this PL day column over here, there was one that was flat or zero. That was Kellogg. Some of you may not even remember the Kellogg trade because it was put on so long ago, but it's about ready to finally roll off our books. Back on February 11th of 2021, if you watched that video in the archives, I sold a Leaps put on Kellogg for $6.30, and it's finally about to come due. 17 days until it expires. So that one most of you probably don't remember, or perhaps you weren't even watching our videos back then, but that's kind of an outlier in that case. Most of the rest of these, in fact all the rest of these, are trades that I've done here more recently in the last month or two. And so good to see that all of those were up today. Remember, today was a down day for the stock market. It was down 0.4% or whatever it was. And most of my trades are bullish trades, right? You can look at the delta column over here, and I only have 2 bearish delta trades on right now. One of them was APA, which is an oil and gas company. And as I just mentioned a moment ago, oil and gas got hit hard today. So I was happy that that stock was down 6% today. We made 49 bucks on that spread here today. And the only other negative delta trade I have on currently is the one that I'll be talking about later on in tonight's video that I just put on today, this bear call spread on LIN. So all the rest of my trades are bullish delta trades. Today was a down day in the market, and we made money in all of them. So that is a very strange thing. Most of the times it doesn't work out that way, right? If you have a lot of bullish trades and the market is down, you should expect that your trades will likely be suffering as a result. But today was a very strange day where most of our recent trades like Newmont and Target and Tyson did really well today. Remember, I did a sold put on that one. Medtronic and Activision Blizzard, they were all up today. So I wish this would happen all the time. Obviously, that's not going to be the case. We're going to do our best for you. Right now, I do have one trade that's underwater, and that's the Iron Condor that I placed on Google. It has a slightly bullish delta right now, so my preference would be to see Google go up a little bit more. It's still between the strikes, if I'm not mistaken. Yeah, our sold strike is at 87. It's trading at 89 right now, so it's threatening the put strikes there. We're good to go on the call side of the equation, but I'm going to have to keep my eye on that one because it could easily slip a couple couple of bucks between now and the next 17 days. So that one is one that I got to keep my eye on. But the rest of them, we're in good shape on them. Even the ones like the sold puts that we've had to roll and stuff over the months, we seem to be in good shape on at this moment in time. So if you needed a pep talk as to why you should click like on Twitter to get me up and over 100 likes, then perhaps this scorecard will serve as that motivation for you. Obviously, if I'm not delivering trade ideas to you, then I can't deliver winning trade ideas to you. So as long as we're up and over 100 likes on Twitter, I will do my best to continue to try to find winning trades for you, although I can almost guarantee you they won't be as good as things looked here today, with basically a clean sweep of profits here today, which is, again, a major rarity, but fun to see nonetheless. It's always better this way than the opposite, right? I'm sure there's people out there with 12 positions in their portfolio and all of them were down today. So, and that could very well happen to me at some point in the future. So happy when it works out the way that it did here today, and hopefully some of you are getting some nice trades out of these free videos that you find on YouTube as well. Anyway, let's go ahead and take a quick look at our breadth numbers here today. You can see that I've got the S&P 500 pulled up here on the Market Watch Visualize tab, and 267 stocks out of the S&P 500 were up, whereas 232 were down. So again, that's kind of an oddball situation there where the market was down fairly significantly today, but we actually had a few more stocks that were up than were down today. And the reason is because Apple and Tesla had such a big impact on the overall performance due to their market cap size. But your average stock out there, if you were just flipping coins, was up slightly by the slimmest of margins here today. So think of it as kind of a split decision type of a day. We didn't really get overwhelming evidence for the bulls or for the bears today when you're looking at this breadth number here on advancers versus decliners. Let's go ahead and now take a look at our traditional foregrid here. And as I mentioned before, the S&P 500 was down by 0.4% here today. You can see that it was kind of a little bit of a wilder day, right? If you look at the labels up at the top of our foregrids, notice that the daily range label is in orange color on all four of our charts. Remember, what that tells you is that today's range was wilder or more volatile than the average true range, which is basically measuring an average of the ranges over the last several days. So it's a quick and easy way for you to determine, was today a more volatile or a less volatile type of a day from high to low. Today was one of those more volatile types of days, even though the end result wasn't particularly volatile. So anyway, you did have a little bit of a longer lower shadow and a little bit of a longer upper shadow. And the same thing can be said over here for the Dow Jones and for the Russell 2000, and even to a degree with the NASDAQ composite. So a lot of people trying to push the markets around on this first trading day of the year, but you didn't get a overwhelming meltdown for the bears, and you didn't get an overwhelming blast off for the bulls. It probably led to a lot of frustration when it was all said and done for folks that were hoping to get a little bit more directional on the first day. But with the sell-off of 0.4%, it basically confirms that we are still in a bearish posture territory for the S&P 500. Remember, we use that green line to help us along with that. And so the green line on the S&P 500 is actually now in the lower reversal zone. It's below 20 right now. It's at 18. And so whether it's falling or rising, as long as it's below 20, we would consider that to be strongly bearish. And that's kind of where we find ourselves right now. You'll also notice that the 30-day moving average is painted red, which basically means price is below a falling moving average right now, which we do consider more bearish behavior as well. In terms of the Dow Jones Industrial Average, it fared the best today, and remember, that's typically the case. If there's one thing that you've learned from us over time, hopefully there's a lot of things you've learned from us over time, but that's kind of the natural order of things. When we have a sell-off day, the assumption should be that the Dow Jones Industrial Average holds up better than the rest, and that is happening here in this case today. Remember, the Dow Jones is where you're going to find your old school companies like Procter & Gamble and Johnson & Johnson. Those types of companies don't tend to move around with as much exaggeration exaggeration as stocks like Tesla and Netflix that are not in the Dow Jones Industrial Average. So today the Dow was down, but just by the smallest of margins. It was down by 0.03%. So call it flat when it was all said and done here today. Nonetheless, that was enough to push our posture back into that bearish territory. That green line did fall again as a result of today's movement, combined with the sell-off that we did experience on Friday last week as well. And similar to the S&P 500, it does have a red moving average telling us that price is below a falling 30-day moving average. However, I would still categorize the Dow as being the leader amongst these four. Notice that it is the closest to its 30-day moving average. The others have a pretty significant air pocket or gap between where they're trading in the moving average, whereas the Dow is the closest to being able to get up and over it if for some reason the market turned around. And remember, we are in a more seasonally strong time of the year. Traditionally, January is one of the stronger months out there, of course, combined with the continued rally that you normally witness from November and December. But this time could very well be different. Remember, we're in a slightly different type of a market environment now where there's a lot more bearishness afoot, and therefore this could easily be one of those years where January is a little unfulfilling there for the bulls. Remember that tomorrow is actually the end of the Santa Claus rally. Before I left on my vacation, we talked about that a bit and how the Santa Claus rally was just getting going and that it goes until or through the second trading day of the year. So that will be tomorrow. And then after that, the Santa Claus rally is officially over for the statisticians that are keeping track at home out there. So maybe we get a little bit of kind of boost tomorrow, but that doesn't necessarily mean that that is going to set us off onto a bullish course for the rest of this month or the rest of this quarter or anything like that. Right now, the assumption is that we will have bearishness for the foreseeable future until we start seeing these postures change and or these moving averages turning around. Right now, all four of these moving averages are pointing lower, with all four of these indices trading below those moving averages. You'll also notice that we continue to have strongly bearish postures on the NASDAQ and the Russell 2000 as well, as having both of them trading below their 30-day moving average. So it's a clean sweep today. All four of our indices have bearish intermediate postures according to the market forecast technical indicator, and all four of them are trading below their falling 30-day moving averages. That is not a great setup, right? Doesn't mean that things can't change, but that's why we look at the markets as often as we do and produce these videos as often as we do, because if things change, then we will alert you to that and let you know about it. But right now we have to make the assumption that things are going to continue to be challenging, just like they were for much of 2022. So brace yourself, right? There's going to be opportunities on both sides of the ball, just like there is in every year, but prepare yourself mentally for continued bearishness next year. It's not likely to be a runaway freight train to the upside, at least from my perspective, seeing what I see right now. By the way, the NASDAQ was down 0.76% today. So it was the worst performing index, which makes sense given the underperformance of Tesla and Apple. And then the Russell 2000, the small caps, were the second worst performer today. They were down by 0.60%. All right, let's go ahead and take a peek here at the internet briefly. I always like to get a chance to say thank you to those of you that help support these presentations. Last time I did the video, which was before our Christmas break, I got 102 of you to click like. And again, I'll make the same deal with you that I always do. As long as we're up and over 100 likes, I will plan on doing a full-length video the next time I'm scheduled to do the video, which includes a trade application example. And again, as I mentioned earlier, I can't guarantee that we'll have a lot of days like today where all of our trades went in the direction we wanted them to. But hey, the only way you get a chance to even consider those trades is by playing your role in all of this, which is helping us on social media. So if you could do us a favor and click like, that will allow us to scratch your back with more good trade ideas as well. On the other hand, if some of these videos get a little bit too lengthy for you, we can understand that as well. And if you prefer me to only do a 15-minute version of the video with no trade application example, then don't click like for me here on Twitter. And remember, there's actually 4 different ways to get to this specific tweet, or the one that is associated with the video video that you're watching, remember this was last video, so at the end of this video today, I will unpin this one, and then I'll pin the new one that's associated with tonight's video at the top of my timeline. So you could just simply go to twitter.com/Brandon Van Z and click like that way. Otherwise, you can click like directly underneath the video that you might be watching on our website. For those of you that watch these Market Outlook videos on the Market Scholars website, we have that little widget beneath that area for Twitter that you can click on. You can also get the tweeting question by looking in the description area of the YouTube video for those of you that watch it directly on YouTube. And then the last place that you can find it is in the email that we send those of you on our distribution list. There's a little Twitter icon at the bottom of those emails, which will take you to this tweeting question. So there's 4 different ways to add your like to the total tally. It doesn't matter which of those 4 ways you participate in. All 4 of them will allow you to be part of those that get counted towards our goal of 100. And again, thank you to all of you that supported us with the last time around. Thank you to David and to Julie and to Eric and to Venki and to Maria and Greg and Susan and Tom and Emil and Pam and Ryan and Randy, Tim, Kevin, Rich, Fun Jonesy, Lucius, Keola, Jayesh, Trunk, Loey, El Zulu, Teresa, Eddie, My Info, or Julie. Hello, Julie, by the way. I was direct messaging with her here recently, so nice to chat with you a bit there as well. Linda and Michael and Prickly Trader and Curdy and Carlisle, Karen, and others. Too many to get to all of you, but we appreciate you. Thank you very much for taking the 5 seconds out of your day to help support this free presentation that we deliver straight to you and hopefully bring interesting trade ideas to you on a regular basis. Also, let's go ahead and talk about some of the things I've been posting on our website here recently. At the end of the month, I have a couple of things that I do for dividend growth investors that I post to our website. And I always like to remind folks that this particular area of our website is open to all. So you don't need to be a premium member to get access to these blog posts. You do need to be a premium member to attend the dividend growth investing class that I taught today. And today was class number 1 for the coming semester's portfolio. It was a long class, 2.5 hours. So you may have to spend a little bit more time watching the recording on this first one because I have to explain a lot more things on class number 1, like all the stink bids that we placed on some stocks that we want to own if we get some sort of a flash crash out there, and a number of other things. We had some rule changes that I updated our trading plans with, so there was a lot to get through in today's first class. Next week it won't be nearly as long. Nonetheless, today was class number 1 for the new year. So we'll be building out a 25 stock dividend growth investing portfolio here in the next 6 months, and very much looking forward to that. And that's something that I do for our premium members. But for those of you that are not premium members and you're just considering it, I do offer access to these free blog posts. And one of the blog posts that I do each month for DGI is the increases of the stocks from the prior month to see how much they're increasing their dividends and what their current yields are, what their amount of yearly streaks are for raising the dividend, and different things like that. By the way, if you're looking for this area on our website, you probably find them under the recent popular posts here because a lot of people have been clicking on them lately. But anytime you want, even if you don't find them here, you can find it by hovering your mouse over blog and then click on dividend growth investing on the marketscholars.com website. And then you can just click into the most recent posts if you want to get into this information. But here's a quick little view of some of the companies that have been raising their dividends. We actually reviewed this in my class earlier today as well. So if you want to hear my take and my analysis on how some of these companies performed and what my expectations were on them, feel free to watch today's dividend growth investing recording if you are a premium member. Just a heads up as well, some of you might be curious, what do those blue cells mean? As you can see, Broadcom is listed in blue, CubeSmart is listed in blue, Mid-American Apartments is listed in blue, and Trinity Industries is listed in blue. If you go back to the main part of the blog, there's a little line that talks about it directly underneath it that says any rows in the above table that are highlighted in blue feature stocks that raise their dividends at least 10%, have at least 10 years in a row of dividend increases, and have at least a 3% dividend yield. Because normally what you find in the world of dividend growth investing is that if a company has an above average yield already, it has oftentimes a slower dividend growth rate. And oftentimes the opposite is true as well. If you have a company that has a low dividend yield currently, they oftentimes have a rapid or a fast dividend increase percentage. So by identifying those in the blue there, we're trying to find those that have a little bit of secret sauce or special mix of both above average yield and above average dividend growth percentages. So anyway, feel free to take some time to go through that information on your own. And then there was another post that I posted here just yesterday as well, or over the weekend. I do need to wait until the month is officially in the books in order to get the statistics for both of these posts. But this one's just called the Dividend Stairstep Sector Statistics, and same thing, you can find it under the blog Dividend Growth Investing category, and it is available for free. You do not need to be a premium member in order to see this specific post. But what I'm attempting to do in this particular post is get a feel from a sector perspective as to what areas of the market are more attractive than others in terms of those of you that want to buy stocks for the long term. Remember, that's a different approach than what is oftentimes talked about in this market outlook video, which is more of a trading approach. So this is probably not going to be perfectly useful information to all of you listening to this right now, but for the corner of you out there that perhaps are interested in long-term investing as I am, it might be a little bit more impactful information for you. Because if you're going to become a long-term investor, you typically don't want to be buying stocks when they're at all-time highs like a lot of traders are willing to do, because traders are willing to get out of their trades because they're not investing, they're trading. They can afford to be wrong by buying at the top because they're not going to be wrong for too long and they're going to get out of their trades. As long-term investors who plan on being in stocks for years or decades, we have a tougher job. We want to make sure that we are buying at a more appropriate price from a value perspective, and therefore you're going to kind of look at things 180 degrees differently than you would if you were a trader, right? I had a guy in class here earlier today that was bringing in some Investors Business Daily and MarketSmith related statistics and rankings into my dividend growth investing class. And I said, you know what you'll probably find is that because MarketSmith and Investors Business Daily cater to traders, whereas Value Line and Morningstar cater to investors, that it's not going to be as useful information. Sure, it's true and it's factual what he was presenting, but it's just not particularly useful for what we try to accomplish as investors. It would be similar to, you know, if you're playing a basketball game and you go into the game wearing a football helmet and the ref calls a foul on you because you're not wearing the proper basketball equipment, and you go up to the ref and say, well, what gives here? My coach told me that this football helmet will protect me, when the truth is it was the football coach that told him that, not the basketball coach. So make sure you understand which game you're trying to play. Each game that you're trying to play is going to come with different tools and resources that will be useful for your goals and your endeavors for that particular game. So a lot of times long-term investors need to think exactly 180 degrees differently than shorter-term traders who rely upon relative strength. So oftentimes what you find is that when stock prices go down, dividend yields go up, and therefore those companies become more attractive in our eyes as dividend growth investors. So it's not a huge surprise in this case where you see communications up here at the top in terms of sector attractiveness, because communications has been a terrible sector from a price perspective, and as price goes down, dividend yield becomes more attractive. Whereas on the flip side, you got more defensive areas like utilities and healthcare at the bottom that present the fewest amount of attractive opportunities for long-term investors because their prices have done relatively well. So it's kind of interesting dealing with both traders and investors at Market Scholars and having to kind of explain the differences of what you're trying to accomplish for both of them. And there's not a right or wrong. I always tell my students, there is no holy grail in the world of trading and investing, right? the best you can do is find a strategy that fits your personality. For me, it's dividend growth investing, but for many of you, it's probably not. Again, this video here on YouTube happens to cater to the trading community, which is a little bit more in alignment with what David does. David's more of a trader, I'm more of an investor, but hopefully between the two of us and the 8 trading rooms that we teach, we can teach to a wide variety of techniques regardless of what it is that you as an individual are hoping to accomplish, right? So that's kind of the goal of the education and helping you guys all feel more confident in what you're doing. And hopefully many of you have experienced that with David and I in the past, and if not, we would look forward to the opportunity to helping experience that with you in the future if you ever consider becoming a premium member. So anyway, again, feel free to take a look at some of that information if it strikes your fancy. All right, let's get back on track with some more charting analysis now over here on the Thinkorswim platform. Let's come on over here to do some 12 grid analysis. So I'm going to start off with chart 5A, and a reminder for those of you that might have taken advantage of our year-end sale or our Black Friday sale, one of the big perks that you get by becoming a 3-year premium member of Market Scholars is you get access to all the different charts that you see me using in my presentations. And so it allows you to follow along with me a lot better in that regard as well. So for those of you following along right now, I'm on chart 5A. And this first 12 grid here will allow us to see what's happening across a wide variety of asset classes out there. So this is not specifically to the stock market itself. Here we're going to be looking at things like commodities and bonds and cryptocurrencies, foreign stocks, and all kinds of things. So it helps us get a good lay of the land as far as getting an understanding of what's driving the market action out there at any given moment in time. And a friendly reminder that when you're looking at these 12 grid charts, each one of them has a market forecast technical indicator associated with it, but because of the way that Thinkorswim handles it, you can't actually see it unless you expand the miniature chart into a large one. So for an example, let's take gold, which looks absolutely spectacular. Going back to my Newmont comment earlier, Newmont looks spectacular as a gold mining company. Gold itself looks spectacular. And I know I sound like a broken record there because I've been talking about that since basically this breakout back here in November, where I said this move was so aggressive from below the moving average to way above it that even in the normal course of a pullback along the way, I'm expecting this to actually be a trend-changing move. And I was trying to explain how that is not the assumption in most cases, right? Most of the time you stay clicked into your trend. But every so often, something very exaggerated takes place and the trend can actually change. And that is what I believe is what's happening with gold. And as I mentioned last year, I expect that in the year 2023, gold has a decent chance to outperform the stock market. That's my belief. I could be wrong about that. And I also think that gold stands a pretty good chance of even outperforming oil. But we shall see. But today certainly kicked us off in the right direction with gold. As you can see, we are now at 3-month highs on gold. It was up 0.84% today. It didn't close at the highs of the day, but still it was a breakout type of a day for gold. It was its 3rd straight up day, and obviously it's not at all-time highs from over the years, but hey, if we are going to head towards all-time highs eventually, we got to start somewhere, and right now we're starting with 3-month highs on gold. But anyway, if you right-click on any of these charts and hang on a second here. It's taking sweet old time. There it goes. If you right click and then go to maximize sell, you'll actually then see the market forecast technical indicator down below if you wanted to. For some of you, it doesn't really matter all that much because you believe the background colors of the charts or what have you. But this can actually confirm it for you. Why the background color is green in this case is because the green line on the market forecast is back in that upper reversal zone there again. So I really like the way that gold is shaping up here. Gold is more volatile, so that's the one thing we got to be careful of. Things can change fairly quickly in that particular asset class. But right now, this is a nice looking chart that we're seeing out of gold. And I hope we see a lot more of that as 2023 moves along. So it stays with its strongly bullish posture and is above its rising 30-day moving average. The only other chart we can make the same claim about is the 10-year U.S. Treasury yield in the lower right-hand corner. Notice it has a green background color and also has a green moving average. However, between those two charts, I think gold looks a lot better. U.S. Treasury yield is a little bit funky because it can be pushed around by, a lot of the Fed chairs and, Powell and comments coming out from the Fed governors and all this kind of stuff can impact it on a day-to-day basis. But between those two charts, I think gold looks a lot healthier. That's a really strong looking move that it kind of consolidated there for a while in the last few weeks and then bouncing up and off of that moving average. Really like the way that gold looks. Whereas TNX, yeah, you got to recognize it is up nicely off of its lows from last month, but you can also see that it's still well off of its highs from 2.5 months ago. So gold is breaking to new highs. TNX is still trying to think about that right now and kind of just meandering in no man's land. Oil also has a green background color. However, notice that the moving average color on oil is yellow and not green like it is on gold. So that's another reason I prefer gold at this moment in time. Oil took it across the chin today. It was down 3.5%, which led to the sell-off in all of those oil stocks that I had mentioned before. So naturally, oil itself drives a lot of the activity of oil stocks. And so with oil itself down sharply here today, no surprise, a lot of those stocks like Exxon and Chevron, Conoco really took a hit here today as well. So I'm not sold on oil at this moment. It's true that oil has been pretty resilient from a stock perspective, especially on a relative basis versus the other 10 sectors that are out there. But when I look at this chart, it's just not giving me the warm and fuzzy feelings, right? Gold's giving me a little bit more of that feeling. Oil just looks like it's got work to do. It's really choppy. It's hard to trade it properly. And it just gives me the sense that it's a lot more economically sensitive than gold is, right? Gold could theoretically go up even if the economy is in a toilet. Sometimes that is, that's associated with a bad economy because it's inflation that causes the bad economy, and sometimes inflation is what increases the value of gold. So it kind of works together there in that regard. Whereas oil is not really thought of that way. Oil is sold, the supply-demand, mechanism works there just like it does in gold, but there are different reasons to be buying oil than to buy gold. Usually, a strong economy is required to have lots of buying of oil to transport things here and there and to, of course, make things like asphalt and plastics and all that kind of stuff oftentimes requires a pretty strong economy there. So that's why I'm not quite sold on oil right now, and I'm wondering if there's going to be some underperformance required in that area because it had done a lot better than other asset classes last year. Whereas gold was kind of the opposite. Remember, at the beginning of 2022, gold was in the toilet. And it really wasn't till the end of 2022 that it came out of the toilet. And right now, it looks like it wants to assert itself as more of a leadership area. Let's talk about the US dollar in the lower left-hand corner now. And as you can see, we continue to be trading below that falling 30-day moving average, and it continues to have a strongly bearish posture. We actually had a pretty decent bounce out of the dollar today. It was up over 1%, but that was after putting in yet another oversold cluster signal. I think I was with you right on this one when we talked about it as well, which led to a little bit of a recovery, but then rolled over again. And now here we are with another recovery, yet right now the assumption is it stays below that falling moving average, right? If you wanted that to change, then you want what happened with gold, basically an eruption well above the moving average. But at this point, I don't really see the catalyst that would be causing that on the US dollar. So I have to continue to make the assumption that this is a bearish situation for the US dollar itself. And remember, those two things oftentimes go hand in hand as well. When the US dollar is weak, there's a greater tendency for gold prices to go up because gold is priced in US dollars. So if you expect the US dollar to continue in this downward trend, there's a pretty decent chance that you're also expecting gold to continue in its upward trend, right? So let's keep our eye on that. Today was a little bit of a unique day where both the dollar and gold were up. So you don't see that very often, but the prevailing trends are what you would expect. A falling dollar leads to a rising gold price, and that's kind of the prevailing intermediate trend that we continue to work with between that pair. In terms of the other charts, We didn't get a lot of movement out there here today. Of course, bonds were up just a little bit because interest rates were down just a little bit, but they're just kind of stuck in more of a consolidation zone right now. It's not really like a breakout type of a move for those. I would point out that foreign stocks tended to do a little bit better today. And again, that's a little bit odd as well. So similar to gold, it's almost like foreign stocks are calling the bluff of the US dollar. Usually when the US dollar is up, gold is down and foreign stocks do worse than US stocks. But today it was exactly the opposite. So it's kind of like those other areas are saying, yeah, we'll give you an update there, US dollar, because you've been beaten up so badly here recently, but your trend is not changing. So we're just simply not going to believe you at this moment in time. Whether that changes in the future, we'll all find out together. And if that occurs, of course, David and I will bring your attention to it here in these nightly videos. Let's talk about sectors now. I'm going to pop on over here. Oh, and by the way, real quick, Bitcoin was up just modestly here today. Not that it's worthwhile to chat about the whopping 1% move or anything like that, but it just happened to catch my eye as I was about to flip over to the other charts, because I did hear that SBF, Sam Bankman-Fried, did plead not guilty here today, and has a long road, I have a feeling, in front of him to plead his innocence in a court of law as we move forward. But of course, that whole FTX scandal has caused some significant anguish and damage to the cryptocurrency charts that are out there. Right now, Bitcoin does remain below its 30-day moving average, but it has stabilized reasonably well in the last week or so. So who knows, maybe it's gearing up for a move. But if it could get above its moving average, it would be the first time since back here in early November. So it has a reasonably decent chance to do it just because it's so close to it right now. So it wouldn't be the most unheard of thing out there if that could occur. But as you can see, this is a pretty damaged chart at this point. I'm just not sure how many people are going to get excited to chase into something like Bitcoin unless there's some other catalyst that eventually emerges out there. All right, let's go over here now to our Sector 12 grid. This is chart 5C. And so, as you can see here, we had kind of a mixed session here today, which makes sense going back to the comments at the beginning of the presentation where we had a little bit of a mixed bag on the heat map perspective. It makes sense that when we kind of turn our attention to the sectors, we find kind of the same thing. Now, no surprise, as I mentioned before with my hunch, that energy was today's worst performing sector. It was down 3.5%. It's actually a pretty ugly move there, bouncing down and away from that falling 30-day moving average there. So I wouldn't be surprised if tomorrow morning in my factor-based swing trading class, if some of our bearish trade ideas might very well come from energy, because I have a feeling that a lot of individual energy stocks probably look the same way, where you had this little recovery last week, but it didn't get you above the moving average, and now that moving average is acting as resistance as of this moment in time. So be aware of that. Pretty ugly day there for energy, with every single energy stock in the S&P 500 closing lower. In terms of who the best performing sector was here today, it looks like it might have been communications, a rare day where communications led the way. It was up 1.29%. Communications has been pretty ugly over the past full year if you consider that, Alphabet and Meta and Disney and Netflix are part of communications out there. But today you got a nice little recovery there. But I wouldn't make too much of it yet. I don't mind the chart. It's actually kind of carving out a nice little base pattern here. But the problem is it's still below that falling moving average. So I'm going to be a little bit hesitant towards it until it can prove to me that it can stay above it. And even then, I'm still going to have some hesitations because there's been other times it's gotten above the moving average only to fail. It kind of seems to me that we're trading in a sideways range here on communications where you've got a high followed by another high and another high, all in the same general vicinity right there. So almost like a triple top combined with somewhat similar to a triple bottom down below. So you're just kind of chopping sideways on communications. But today it was the leading area of the market there. In terms of what our intermediate postures are telling us right now, we only have 3 modestly green charts on the board, and that's financials, communications, and industrials. But you'll notice that the background colors are light green in that case, not dark green. So it's telling us that we have weekly bullish postures. So in other words, not worthy of being trusted quite yet. Right, it's giving us a heads up that things are attempting to turn around, but not in a roaring bull market fashion quite yet. So we'll keep our eye on that. If that changes, we'll let you know. But right now, all three of them remain below their moving averages. It's just that they've kind of stabilized a little bit more from price action perspective here more recently. You'll notice that none of those three charts are at their 1 or 2 week lows right now, whereas other areas like staples, as an example, actually touched a multi-week low here earlier today. Materials is right down there in that general vicinity as well. So just keep your eye on some of those movements. All right, let's go ahead and talk about our trade application example for the day now. And I kind of spoiled the surprise already. Sometimes when I'm off the cuff like I am here during these presentations, I never know what I'm going to say until it's actually said. So some of you already saw that the trade application was a bear call spread on Lin. So let's talk it through here. I'm going to come over here to just a normal chart 3A that I use for the swing trading classes. And we're going to pull up ticker symbol LIN. This is Lindy PLC. This is a business that I actually like quite a bit, so I'll put that out there to begin with. But just because I like businesses doesn't mean I like the valuations of businesses, and that's an important thing for people to remember. This is a very impressive industry that it belongs to. In fact, we were just talking about one of its competitors earlier today. In fact, I think I still got my screenshot pulled up. If I do, I'll show you what I'm talking about. We talked about stink bids earlier today in my dividend growth investing class. And for those of you that were in my DGI class back in August of 2015, you'll know that we had a day for the ages back then. That was the day of the mini flash crash. And these were a bunch of the stocks that we got filled on that particular day because we had our orders set in advance. So looking at a stock like John Deere, where we bought it at 77 bucks and today it's trading at over $400 or whatever it is, it's been a remarkable type of a move for some of these companies. So every so often you get lucky that way. So we like to have a few trades in the hopper in my dividend growth investing class, just in case we have a day like we successfully completed back here in 2015. This is obviously the exception to the rule. Most of our portfolios, we don't get this fortunate, but we have had a few stink bids hit here and there more sporadically over the years. This was the day that they all hit very consistently because of the unique mini flash crash that happened on August 24th, 2015. But anyway, one of the stink bids we put on earlier today in my DGI class was Lindy's competitor, which is Air Products. This is actually a company that we bought in my DGI class about a year ago, and this stock has done fantastically well in the last year compared to the rest of the market, right? We bought it back here closer to 216 when it had a 3% dividend yield, and it's done really well, especially recently, going back to all-time highs in this market recovery that we've had in the last couple of months there. So that's a good thing for those of us that bought it back here in my DGI class. It's a bad thing if you're now looking at it today up here and you're saying, well, geez, I wish I could buy it down there under 220, right? So we did put our stink bid here earlier today on Air Products, but it goes all the way back down there to 216, and so it would require a pretty aggressive sell-off in order for us to get filled on that, and it's probably unlikely to happen. But I wanted to use this to kind of show you that a lot of these industrial gases companies have really exploded higher and are probably perceived to be overvalued right now. Another way to look at that, by the way, is I could pull up our dividend stair-step chart, which, by the way, I'm working through the new calculations right now. So for those of you that are premium members, I'll be getting you the new chart links here within the next month or two, because these stair-step lines change as time goes on because it's calculated on a rolling basis. But anyway, if you were to look at Air Products here, you can see what I was referring to. Last year it came down here into that blue zone, and now it went back up here into this orange zone and hit a new all-time high. So we would consider Air Products to be overvalued right now. Same thing can be said for Lindy. Lindy is way up here in this orange overvalued area. Now, what I did here earlier today is not meant to be a long-term trade or anything like that, so it's not all that meaningful that it's considered to be overvalued on a long-term perspective. Nonetheless, it could be maybe another feather in your hat as to why you might consider a bearish trade, because not only from a technical perspective is it's starting to slip a bit, but it's also considered to be overvalued from a lot of fundamental analysis that we do here at Market Scholars. So let's go back to the trading conversation right now and look at the 3-month daily chart now on Lindy, ticker symbol LIN. And you can see that it was down 2.5% today, or 2.4% today, so it vastly underperformed the market itself today. It did close well off of its lows like the market did as well, but this was a pretty ugly day for this company because of what happened with that 2.5% move. As of Friday, you were still sitting in this kind of precarious position where you were at the lower end of the multi-week range, but it still had a chance to pull a rabbit out of the hat and bounce and still stay in that sideways range. Today ruined all of that. Today, you broke down easily below all of the trading that has occurred with this stock going back to the first week of November. So all of the last month and any sort of constructive activity that occurred during that time period has now been thrown away. So you now broke to more than a 1-month low as it stands right here. And in doing so, the background color went to pink, as you can see, telling us that we have a bearish near-term posture. You also see that the moving average color is red, telling us that price is below a falling moving average, which is more of a bearish feature. So for those reasons, I did a bearish trade on this one here today. As mentioned before, I sold a bear call spread in the month of February. I think I sold the 340 strike and I bought the 345 and got a credit of $1.30. So our break even on that trade is 341.30, and this blue line that you see up here represents where our break even is. So for those of you that are newer to this idea of selling a bear call spread, basically what I want with this trade is for Lindy to stay below that blue horizontal line right there. As long as it can do that from now until expiration date, then I should be able to make money on this. And I made about a 30% return on risk when I did this trade here today. And that's usually what we shoot for on our credit spreads. You can see that it did trade above that blue line on a couple of occasions in the last month, but really only did it for a day or two at a time. So it seems like there might be some legitimate selling resistance in that vicinity as well. But ideally, we want this to continue to weaken, so that way we don't even have to sweat the trade out. But if it does rebound a bit, we've got the falling 30-day moving average to represent a possible resistance area, and then we have a further possible resistance area at the blue line itself where we had some selling more previously. Okay, so that's what I had for you. Hope you enjoyed tonight's presentation as I'm kind of back in the swing of things here. Hope you all had a great holiday season. If you got enjoyment or value out of tonight's video, I ask one simple request out of you. Take 5 seconds out of your day and click like for me there on Twitter. As long as we're up and over 100 likes by the time I'm scheduled to do the video again on Thursday, I'll try to find another trade application example like I just showed you here with Lindy. On the other hand, if you prefer the shorter videos and you're okay with not having a trade application example, then don't click like on Twitter. And whatever side of 100 we land on will dictate what I do for you on that day. So again, great to be back in the saddle. Happy New Year's to all of you. Have yourself a great rest of the night. Best of success with your trades and your investments. Goodbye for now.